Hello options traders and Facebook fans, and welcome to another mini trading tutorial from OptionsA2Z.com. And today we're going to answer the question, what are options? Let's say that you wish to invest in Facebook, and it's been pushing close to $170 here recently. And that means you have to pay $170 per share. Most people trade in 100-share lots, so that's going to be pushing $17,000 to take a position in Facebook. Is there a better way? Is there a more cash-efficient way? Is there a way that will give us defined losses, all things that we can't do with shares of stock? The answer is yes, and that's where options come in. Options are exchange-traded assets, just like shares of stock. And with all the ease and convenience of buying and selling shares of stock, you can do exactly the same thing by buying and selling options. Just click on Buy or Sell in your broker's platform. So what exactly is an option? Well, options are contractual agreements to buy or sell shares of stock at a predetermined, or what we call a fixed price, over a given time period. You have two types of options to choose from. There are call options and put options. With a call option, the owner, that is the person who buys that option, has the right to buy 100 shares of stock at a fixed price over a given time. On the other hand, if you buy a put option, that makes you the owner, and the owner has the right to sell 100 shares of stock at a fixed price over a given time. Notice that both definitions are identical. Call options give you the right to buy, put options give you the right to sell. If it helps you to remember, call options get their name because what you're really doing is calling shares away from another trader. It's as if you're saying, I have decided to call shares away from you. In other words, I am electing to be the buyer. On the other hand, if you have a put option, what you're doing is putting shares back to another trader. It's like you're saying, I don't want my shares anymore. Here you go. I'm putting them back over to you. In other words, I am electing to be the seller. The important point to understand is that buyers have rights. It is your option to choose. So remember, you are never required to buy or sell shares of stock when you own an option. It's your choice, and that's where options get their name. You choose. So how do options work? Well, they're quite easy, actually. In fact, I'm sure that everybody here has used something very similar to a call option. Take a look at this. A pizza coupon. If you've ever held a pizza coupon, you know the mechanics of a call option. Here's why. The pizza coupon gives you the right to buy something. One large pizza in this example. In options trading, it would be 100 shares of a specific stock. But you are not required to use it. It is a right to buy. However, if you choose to use this right, you have a fixed price. In this case, $10. No matter how high pizza prices may rise, your price is fixed. And finally, you can only use this coupon for a given time. There is always an expiration date. In options trading, this fixed price, the $10 figure we saw in the pizza coupon, is actually called the strike price. And that's really a slang term because it's the price where the deal was struck. So for example, if we buy a Facebook May 130 call, that 130 figure right there in yellow is the strike price. And that means we have the right, not the obligation, to purchase 100 shares of Facebook for the fixed price of 130 per share. That figure is also known as the exercise price. And that's because in the business, if you choose to use your call option, you would exercise it. And that's just simply pushing a button in your broker's platform saying, yes, I am electing to buy 100 shares. And that's called an exercise. And upon exercising, that 130 figure there is the price you would pay. So that's why it's also called an exercise price. Unlike pizza coupons, you do have to buy options. And the price you pay for an option is called the premium. So let's say that our Facebook 130 call is trading for $5. That's the price we see in our broker's platform. Because each contract controls 100 shares of stock, it really means the total price will be $500 plus commissions. Today's commissions are pretty cheap, probably less than $5 or $10 to buy that contract. One big advantage, though, right off the bat, is that the premium is the most you can lose. Think about that. If you bought 100 shares of Facebook for $130, that's $13,000. There's no way you could guarantee that the most you could lose is 500. But with the option, you can. The strike price increments are fixed by the exchanges. They come in usually 50 cents at the lowest and up to $20 on the highest. This is one of the limitations of having what are called standardized contracts. They're like cookie cutters. We can't get all the strikes that we may wish. We only have so many to choose from. But generally speaking, if your stock is somewhere between 50 and 200 for the stock, those strikes will usually be in $5 increments. So let's say that we buy the Facebook May 130 call. What does this do for us? Well, it means we have the right, not the obligation, to buy 100 shares of Facebook for the fixed price of $130 per share through the expiration date in May. It works just like a pizza coupon. The expiration dates will always clearly be listed on your broker's platform, but they are generally going to be the third Friday of the expiration month. So for May of 2017, we find Friday, third Friday down, they would expire on the 19th. Expiration dates generally range from anywhere as little as 1 day to nearly 3 years till expiration. But at any time, up to and including that expiration date, you can buy, sell, or exercise your option. Now here's where the real value of call options comes in. Because you have locked in your purchase price, call options increase in value as the stock price rises. And the way that call options work is that they will gain what's called intrinsic value as that stock price rises above your strike price. So for example, if we buy the 130 call and the stock rises to 135, we have $5 of intrinsic value. That call option is giving us the right to buy shares at a price that's $5 less than the current market price. And that means that that call option must trade for at least $5 in the open market. To see how it works, let's say that we bought our Facebook call when the stock was down here at 130 and we paid $5 for it. Remember, that actually means 500. And at some point, Facebook rises to 140. Well, that 130 call now has to be worth at least $10. That's the intrinsic value. So we could, if we choose, sell that call to exit the contract. We paid 5, we received 10, we doubled our money. Keep in mind that 10 really means $1,000 because we have to multiply that 10 times 100 shares per contract. What if Facebook rises to 150? Now the 130 call has to be worth $20 or $2,000 total. We paid 5, we sell for 20, we made fourfold on our money, and we're out of the contract. What if Facebook comes all the way up here to 160? Now the 130 call has to be worth $30 of intrinsic value or $3,000. We paid 5, we sell for 30, we're out of the contract. So as long as the stock price continues to rise above that strike, the call option's value increases. Once you understand call options, put options are pretty easy to understand. They're the same idea, just in reverse. It's best to think of them like an insurance policy. So just like with your car, if you wreck your car, you can put your car back to the insurance company and say, I don't want it anymore. Here, I'm putting it back over to you. And they are going to pay me cash in exchange for that. And that's really the idea behind a put option. So let's say, for example, that we buy a Facebook May 170 put. If we purchase this, it means we have the right to sell 100 shares of Facebook for the fixed price of $170 per share through the expiration date in May. For put options, we get a benefit by locking in that selling price. However, because you have locked in your selling price, put options increase in value as the stock price falls. It's just the opposite of call options. So the intrinsic value for puts is built up by having falling stock prices. So if we have the 170 put and Facebook falls to 165, that now has $5 of intrinsic value. And we know that 170 put has to be worth at least 5. Why? Because we have the right to sell shares for 170 when anybody else in the market would only receive 165. There's a $5 benefit being conveyed in that put option, and therefore that value must be reflected in the open market. So if we bought the Facebook 170 put up here for $5 and the stock fell to 160, there's $10 of intrinsic value. We could close that put by selling it in the open market. We paid 5, we sell for 10, we've doubled our money. On the other hand, if Facebook falls to 150, that put option now has to be worth 20. We paid 5 and we sell for 20. We've made fourfold on our money. And if Facebook falls to 130 down here, we have the right to sell for 170. It's trading at 130. There's now $40 of intrinsic value. We paid 5 and we can sell for 40 and we're out of the contract. So put options allow you to profit from falling stock prices, but at the same time, limit your risk. If you're interested in the art and science of options trading, please check out the Alpha Trader course at optionsato z.com.